Welcome back to the deep dive. You hand us the sources, the technical papers, the financial reports, the community chatter, and we pull out what really matters. And today, we are plunging deep into the Pi network, a project that for years has felt like it's been just on the verge of something.
Exactly, and that's why December 2025 was such a strange month to analyze. We
Hmm.
saw this paradox emerge. On one hand, you had signals that looked like a slowdown, but on the other, you had this massive acceleration towards a real launch.
Right. The sources we dug into show these big, almost jarring internal changes, especially with the mining rates happening at the exact same time as these, well, frankly, huge moves into regulated, serious financial markets. So the question for you, the listener, is pretty simple. Has Pi finally moved from just being a hype machine to something that's actually, production ready?
And just to get everyone on the same page, Pi Network, launched back in 2019 by some Stanford PhDs, has this very simple idea. You mine Pi coins on your smartphone. You just check in once a day. This whole deep dive is about where that project is now and what all the activity in December really tells us.
So our mission today is to stitch all these updates together, the mining rate adjustment, the infrastructure buildup, that big institutional news, and give you a clear picture of why December 2025 is being seen as this huge turning point.
Okay, let's get into it. We had to start with the number that just it doesn't make sense at first glance. In December 2025, the base mining rate actually went up. Not just a little bit. It jumped 13.59%. It went from 0.000076 pi per hour to 0.00313.
And if you follow crypto at all, you know that's weird. Mining rates. They almost always go down, right? They go down to create scarcity or because more people are mining. So a double-digit increase really makes you stop and ask, what's going on? So, wait, the rate jumps over 13%, but the justification is that it's a protective mechanism. I mean, isn't that just a bit of spin? Aren't they just trying to put a positive light on the fact that people are leaving the network?
That's a totally fair question. And the answer is kind of yes and no. It lies in the algorithm itself. It's a dynamic system. It's not a fixed rate. It's designed to adjust based on active participation. So, in simple terms, when fewer miners are active, the system automatically gives a bigger piece of the pie to those who are left.
Yep.
So it's a built-in feature, not some manual override. The idea is to keep the network secure and decentralized by making sure the core group that sticks around is rewarded enough to stay engaged.
So who was leaving? And why? Our sources seem to point to four pretty clear reasons for this churn.
That's right. The first two are, well, they're about money and patience. Number one, the low market price. Pi was floating around 22 to 28 cents on these unofficial markets. So for a lot of people, the daily check-in just didn't feel worth it. And second, the wait. Just the long wait for real uses for the coin and that slow KYC, the identity verification process.
And the third reason was external, right? The whole landscape was changing. 2025 saw this boom in other mobile mining projects. Pi suddenly had real competition for people's attention.
It did. And then number four, this was an internal thing, a huge event. The unlock of 190 million tokens in December, that's a massive influx of supply, and that was bound to create selling pressure and, spook some of the short-term holders.
So the 13.59% increase, it's not a bonus, it's not a gift, it's the network's immune system kicking in.
That's a great way to put it. It's an adaptation to churn. The loyalists are basically getting the share of those who left. It's a stabilizing act. But while that's happening internally with the community, something completely different is happening in the world of traditional finance.
And that's the pivot that's so fascinating. It almost feels like two different projects. You have a user on their phone seeing this small rate bump, and at the same time, you have traders in Sweden buying regulated financial products.
Yeah.
How do those two realities even exist at the same time?
This is where you can start to see the long-term strategy, I think.
Yeah.
They're managing the community, yes, but in parallel, they built this on-ramp for serious money. And that is the launch of the Valour ETP. It's an exchange-traded product, and it started trading on the Sweden Spotlight stock market.
Okay, for anyone who doesn't live and breathe finance, break that down. What actually is an ETP? Functionally, what does it do?
It sounds complex, but the function's actually pretty simple. An ETP is just a security that tracks the price of an asset, in this case, Pi, and it trades on a normal stock exchange, just like a share of Apple or Google. The key thing is big institutional investors. They often have rules that say they can't hold crypto directly. It's too volatile, too risky from a custody standpoint. This ETP puts a legal, regulated wrapper around Pi, so a pension fund or a major investment firm can get exposure to its price without ever having to touch a crypto wallet.
And given Pi's history of being seen as, speculative, the regulatory part here must be massive.
It's everything. The sources point to three big credibility boosts from this. First, as we said, institutional access without the technical headache. Second, it's regulated under Swedish financial supervision. That's a huge stamp of approval in Europe. And third, it's the very first time a Pi-related product has been listed that is fully compliant with all the established financial rules.
So what this really means then is that the team was building these regulatory rails all along. They weren't just relying on the hype that defined the project in, say, 2021 or 2022. This is a move toward credibility, not just chaos.
A very deliberate pivot. Think about the timing. They unlock 190 million tokens, which could crash the price. But at the same time, they open this compliant institutional funnel to soak up some of that supply. The two things are working together. It signals a real push for long-term stability.
And that idea of building for the long term, moving past just speculation, that brings us straight to the tech, the infrastructure. This might be the clearest sign that the mainnet is actually getting close to being production ready. And it's all about getting the PiDEX, the decentralized exchange, up and running.
The DEX is the whole endgame. It's the piece that lets users trade Pi for other assets directly on the network, without a middleman. It lets the market set the price. And to get there, they've been doing this deep technical cleanup for something called Protocol 23.
Cleanup sounds kind of boring, but the technical sources made it sound absolutely critical.
Oh, it is. It's like checking every single wire in a power plant before you flip the main switch. They've been scrubbing the test network clean. We know it's almost done because there are only 8 old, obsolete test tokens left in the system. That means they're stripping it all down, debugging it, and getting it ready for real, high-volume transactions. The kind of volume a DX launch would bring.
And this is where we find the most, the most bullish statistic of all, one that completely contrasts with the small drop in casual miners. We're talking about the explosion in the number of validation nodes, the actual foundation of the network.
Yeah, just let this number sink in for a second.
Huh.
In March of 2025, there were 23 validation nodes on the Pi mainnet. By December 2025, there were 296. That is a 1,200% increase in 9 months.
A 1,200% increase in the core infrastructure while the number of casual users dips slightly. That confirms the whole story, doesn't it? It's a shift from quantity of clicks to quality of the network.
It absolutely connects all the dots for you. A node isn't just a phone clicking a button. It's an active server that's validating transactions, securing the ledger. More nodes means more security, more redundancy, and crucially, a much higher capacity to process transactions. They're building a superhighway right before they open all the on-ramps with the DEX.
Okay, so let's put it all together. Why was December 2025 the moment? It wasn't just one thing. It was this perfect storm of events all happening at once.
The sources lay out 4 things hitting in perfect synchrony that month. First, that huge 190 million token unlock, which forced the issue of price stability. Second, Protocol 23 was getting its final polish, which is the last technical step before the DX can even be considered.
Third, the KYC process sped up, reportedly by 50%. That's huge because it gets rid of the bottleneck that's kept so many verified users waiting on the sidelines.
And fourth, the Valour ETP going live. That first regulated path for institutional money to flow in. When you put the internal tech maturity next to the external regulatory validation, you have something that looks very, very different from your typical crypto project.
The sources we read describe this whole dynamic, fewer miners, but exponentially more nodes, not as a bad sign, but as a rebirth.
Yeah, a rebirth into a smaller, but technically far more robust network. It looks like the core team made a conscious choice. They chose infrastructure, compliance, and real-world capability over just chasing user numbers or, short-term hype. They're building the cathedral before they invite everyone inside.
And to bring this back to you, the listener, who might just be mining on your phone, that rate increase is nice. Sure, you could get up to 0.008 Pi per hour with all the bonuses. But the real message here is one of adaptation. The network is hardening its core. It's getting ready for the day the doors open to real, regulated, high-volume trading.
That 13.59% increase is, at its heart, a signal of that adaptation. The casual crowd might have thinned out a bit, and that makes sense when the promise of easy money fades. But the actual foundation, the nodes, the protocol, the institutional on-ramps, that's being scaled up massively.
So the DEX launch isn't just another feature drop, it's the moment Pi could become its own autonomous economy. In that light, the higher mining rates are sort of described as the price of entry for the loyalists who stuck around for this critical moment.
Precisely. And it's interesting, the biggest moves that signal Pi's potential longevity are happening quietly. They're happening in regulatory filings and in server rooms. It's a sharp contrast to the loud speculation you see everywhere else in crypto. And it leaves you, the listener, with a really important question to think about. What does this focus on traditional financial compliance really mean for the future of a token that started with a simple idea? Just mine it on your phone. Can a regulated ETP and a decentralized community of button pressers truly coexist in the long run?
A fantastic, provocative thought to leave you with. Thank you for diving deep with us.